It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Lizzie Burden in for Bonnie Quinn with your Bloomberg Brief. Let's set you up for the day ahead. Futures gain after tech drives stocks near a record high. Investors await retail sales data out later this morning. A global bond spree. Alphabet lines up sales of sterling and Swiss franc bonds, including a 100-year note. And earnings continue with Coca-Cola, Marriott and Ford all on deck. Well, a very good morning. Welcome to Tuesday. And US futures are waking up. Modest gains now after the S&P, as I say, came within a whisker of all-time highs yesterday. We've got a raft of US economic data on the docket for the week, starting with retail sales later. And it seems in the meantime, traders are holding their breath. So if we take a look at the bond space, you can see the two-year yield is pretty stuck at the moment, barely budging. 347 is where we trade, and not a lot of movement across the rest of the curve either. So yields down a touch as we await that data. Let's look for some action, shall we, in the single stock story with our stocks to watch. Here's Abir Abu Omar.
Good morning, Lizzie. We're going to start with TSMC, which reported earnings earlier. Now, what we know about the stock is that it's having a pretty good year, 17% up so far this year. It's reported the fastest growth in sales on a pace level for the past few months. And so we know that the sales accelerated by 37% in January. Again, that is the fastest pace. But moving on to another side of the AI story. Now, TSMC is doing well when it comes to artificial intelligence. It's one of those stocks that are benefiting. But let's talk about onsemi now. The stock is down 5%. It was down a little bit more earlier, but it's paired some of those losses. Now, what we know is that revenues came in slightly short of expectations. The shares, again, as I mentioned, fell more than 6% earlier. First quarter guidance shows that there is a slow recovery in demand. And we know that BI has published research earlier this morning as well, suggesting that the recovery in the company is uneven. And then finally, with AstraZeneca, moving on to the healthcare sector, we had the CEO earlier, actually, and he was talking about health, the health sector generally. He was talking about weight management drugs and their demand in the U.S. The stock is doing pretty well. It is the biggest gainer by points in Europe this morning.
Abir, thank you. And Abir will be back with us later on this hour. We also have coming up this hour a look ahead to the deluge of key data this week. I'll be speaking to Seema Shah of Principal Asset Management. And then later on in the hour, a conversation with the chair of the Munich Security Conference, Wolfgang Ischinger. Well, let's get back to tech. Alphabet specifically, and Google's parent company kicking off its sterling and Swiss franc-dominated bonds for the first time. Joining us now to put it in context is Tom McKenzie, host, of course, of Bloomberg Tech Europe. And Tom, this is ultra-rare stuff. You don't often see a 100-year note. Just put it into context of how significant it is for the CapEx story.
Yeah, well, both Alphabet and investors then taking a punt that Alphabet will still exist in 100 years' time. What will Alphabet look like in 100 years' time is a question. But look, the point is, and this is what you're zeroing in on with your question, is that there's very strong demand for these companies that are issuing, of course, huge amounts of debt to fund that CapEx and that spend on data centers and AI. Alphabet wants to be spending potentially up to $185 billion this year on that kind of infrastructure. So it's tapping the public markets. And so far, it's been very well received. It issued about $20 billion yesterday, US time, in terms of US dollar denominated bonds, and that was very received. They had demand of about 100 billion when they were only raising 20 billion, and they came in with yields of just 95 basis points or so above US Treasury. So that shows that the level of demand. Spreads were pretty tight. Now they've issued it in sterling, that 100-year note, and they expect to see demand from pension funds and insurers as well, also in the Swiss franc. So again, these are companies with balance sheets. Now the free cash flow of Alphabet, I should point out, is coming lower. They still have plenty of cash on the balance sheet, but it has come down pretty significantly from historical standards. But clearly there's an opportunity to raise money at relatively cheap levels to fund that expansion, and that's what they're planning to do. And Alphabet is not the first, and it certainly won't be the last this year.
Abir flagged the TSMC sales numbers earlier, Tom. Really impressive stuff. 37% jump in January. That's got to be a good sign for AI demand.
It is. Look, it's another tick in the box, another litmus test. TSMC, which of course manufactures the chips, the AI chips for the likes of Nvidia and AMD, seeing that significant jump in sales. There may have been some seasonal effects. This was over the holiday period, so you do expect a ramp up then. But again, to your point, it's another check. Yes, there is still this demand. TSMC is seeing that come through, and so we continue to monitor their sales, which come through on a monthly basis.
Also want to talk to you about these US insurance broker stocks pummeled yesterday, Tom, because of an AI app. Is that kind of inevitable that you're just going to see sector by sector attacked by AI?
I think sector by sector, you're going to get more volatility because more products can be put out, not just by the large language models, not like just by the likes of Anthropic, which of course caused that market volatility last week when they came out with that plug-in around the insurance sector that raised questions about how defensible that sector was and what would happen to legacy businesses and financial services insurance. And today, of course, to your point, and the legal space, I should say, when it comes to Anthropic, today it's about the insurers, it's about Insurify coming through. It's a private company with a product wrapped around a ChatGPT product wrapper, and what it does is raise questions again about what happens to the insurance space. So yes, there will be more products that are shipped from these companies that will, you should expect, create more volatility going forward. Different sectors will be under pressure. They'll have to show that they can maintain the kind of profit margins that historically their investors have been expecting, and whether they can really kind of defend their businesses in the wake of some of these AI offerings.
Tom, I also want to talk about this memory chip squeeze. You've got a gap really widening between the winners and the losers here. Does it just keep on growing?
Well, certainly the view is that you're not going to get an end to the shortage in memory chips potentially until 2027. And so, yes, there are the winners and there are the losers. A basket of Bloomberg stocks that includes the producers of these memory chips like SK Hynix in South Korea and Samsung, that is up about 160% just since September. DRAM prices are up about 600% just in the last few months. Those are the winners. The losers are the Apples of the world, the Nintendos of the world, car makers who have to, of course, consume these memory chips and now face the shortage, a squeeze on margins, higher prices, what that means for consumers as well as these chips continue to be diverted to the data centers. And that takes us back to the TSMC story that we hit at the top there.
OK, Tom, thank you so much. That's Bloomberg's Tom Mackenzie. Well, here in Europe, shares of Kering getting a post-earnings boost with the biggest earnings surge since 2020. Let's get more on this with Andrea Felsted of Bloomberg Opinion. Andrea, Gucci, sales down, but Kering shares up. What's Luca de Meo doing?
Well, Gucci was a sort of little bit better than it was in the previous quarter. He also talked about growth across the group this year. So the hope is that Gucci is through the worst. He also talked about the Chinese cluster improving. Obviously, that's very important for luxury. So really all those things seem to be lifting the share price.
And sad news that McQueen's going to be cutting jobs and shutting shops.
Yes, exactly. Luca de Meo talked about a 20% reduction in shops across the group. McQueen will probably take a lot of those because it did expand very quickly, and demand for those sneakers that everyone was wearing a few years ago really fell off a cliff at that time. So it really needs some work. The bigger question is, will Kering hang on to it, or will they try and stabilise it and then perhaps offload it?
So a lot of pressure on Milan Fashion Week, which I know you'll be attending. We also got to talk, if we're speaking about events, about the Super Bowl, because you've been writing about the fashion there. It's not Celine, it's not Alaya, it's Zara.
I know, it's a genius move. It's just like genius that, the fashion brand got your fast fashion. What we know is fast fashion got itself, that prime spot on the Super Bowl. But it's really a moment for Inditex, and Zara is, of course, the flagship brand, because Zara has been stretching up market. And this comes back to luxury. Luxury has gone so expensive that, people who bought designer clothes, many of them have just been priced out, and they're looking for alternatives. We've got lots of mid-market brands like Cézanne, M&M in Britain doing well, and there's a space for Zara to also play in this mid-market. OK, you still get, cheap tops, cheap shoes, but it's stretching its price architecture.
Does Zara, as a luxury brand, which feels weird to say, have more of a shot in the US than it does here in Europe?
I think so. This is the other significance of the Bad Bunny tie-up because it's really, Inditex has really identified the US as a big market for growth. It still only has around 100 Zara stores there, and Massimo Dutti's only just gone back into physical bricks and mortar. So there's lots of white space in right across America for the brand.
Just coming back to the broader luxury story here in Europe, you had the LVMH earnings, not such a pretty picture. A more positive story out of Kering. Broadly, where are we at when it comes to the luxury sector now?
We're past the worst. The big declines of last year are definitely in the rearview mirror. America is spending, US consumers are spending on luxury. There's a bit of hope that China will come back, but it's not going to be a V-shaped recovery. China's going to be a slow burn. We've got a lot of new, more than a dozen new creative directors. That's coming into shops now. I've got Dior, I've got Gucci. That's entering the market, and that's creating some excitement, and it will be an excuse to buy. But that said, investors just got too carried away. They were too negative in the summer. They thought no one was going to ever buy luxury again, which was, ridiculous. And then they realised actually the luxury market has got a pulse. They piled back in and probably got a bit ahead of where things are. So the LVMH was a bit of a reality check for investor expectations. But, this year, as long as the designers work, as long as they can address some of those big price increases and rebalance pricing, which is tricky, but possible with, perhaps some more, affordably priced products.
It's not what I would use as a description of the Dior stuff lately.
Exactly. Then we should see an improvement.
All right, well, let's see how it goes. Andrea, thank you. Andrea Felstead there of Bloomberg Opinion. Now to some other top stories trending on the terminal this morning. Barclays is planning to return at least £15 billion to investors by 2028. The bank's fourth quarter earnings beat estimates. Its fixed income and equity traders had their best fourth quarter since at least 2016. Investment banking income, meanwhile, was flat.
I'm very pleased with the numbers. Our top line is 29.1 billion, which is 9% higher than it was a year ago. Our bottom line, 9.1 billion pounds profit, which is again 13% higher than it was a year ago. And all parts of the bank, including the investment bank, firing on all cylinders, ROTE of 11.3%, and capital distribution of 3.7 billion pounds compared to 3 billion a year ago. The new strategy is about acceleration of what we've been doing.
BP is halting its share buyback programme as pressure grows to deliver on turnaround efforts. It's prioritising balance sheet repair over investor payouts. It's also withdrawn standing guidance of returning 30 to 40% of operating cash flow to shareholders. And Keir Starmer has shored up his position as UK Prime Minister for now, after securing public support from his cabinet and delivering a defiant speech to his MPs. Starmer's position remains fragile, though, following controversy over his appointment of Peter Mandelson as the UK's ambassador to Washington and the latter's links with Jeffrey Epstein. Well, coming up, AI disruption ripples across sectors. More on that with Seema Shah of Principal Asset Management next. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. We've got tech stocks building on the rebound after an AI-driven sell-off over the past week. Seema Shah of Principal Asset Management writes, technological disruption rarely eliminates all incumbents, but it does reshuffle the hierarchy. The AI era is likely to do the same. She's Chief Global Strategist and joins me now. Seema, thank you for joining me. Where are we going here when it comes to tech? Do you buy dips? How do you know what's worth buying?
Yeah, look, I think the narrative for AI has become so much more complicated. If you think just a year ago, the general narrative was like, we want to be in technology, buy everything, and it's going to do well. And increasingly, so you saw in Q3, Q4, these questions around the AI capex spend that created some winners and losers. And now you're getting to the point where we're starting to think about what AI disruption actually does for the industry itself, for that sector. So, there's been a lot of indiscriminate selling. There are going to be opportunities, but I think now it's a case-by-case basis where you have to look at this specific company. What is their model? Of course, what is their balance sheet? but how protected are they against AI disruption? Or, are they going to be key beneficiaries?
And in your notes, you kind of welcome the diversification. Where do you see the opportunities around the world in tech?
So Asia is a clear one which has continued to do well. And, of course, it has less exposure to software than you do in the US. That continues to be really attractive. And, of course, valuations were a little bit cheaper. So we have seen continued interest, I think, increasingly over the last 6 months or so, where people are looking more and more across at other parts of the world. And if you like technology, if you believe in the narrative, then maybe looking across to Asia, where there are still some more opportunities coming through. That continues to be interesting.
Just coming back to the US, we've got a load of data coming out this week. Retail sales later, payrolls and CPI in the post as well. If we have weak hiring, weak spending and high inflation, does this sell-off on the stock market continue?
Yeah, look, that will be tough, because I think one of the things that you've seen is, for example, the S&P 500 hasn't really moved that much, the equal weight reaching record highs. And the reason is that there's a strong macro backdrop, so you've seen a rotation away from tech to so many other parts of the market. And there's a number of different narratives which are playing through, from looking at cyclicals to some of the unloved value, etc. But that is really based on the idea that there is a strong macro outlook, and you're going to see a broadening of earnings growth. If that comes to question, so if we do get a run of really weak economic data, which increases economic risks, well, then that rotation trade is in danger, and then you could see a bigger downdraft across the S&P 500. Now, that's not our expectation, but certainly it's a risk, and we saw from the unemployment numbers, the labour market numbers last week, that investors are certainly very cautious about this.
We also got to talk about Kevin. You're talking about the macro backdrop. President Trump says that Kevin Walsh can get 15% economic growth. We're not really sure what time frame he's talking about, but that's a whole lot of rate cuts. Anyway, his call for a new Fed-Treasury relationship. Let's say that in reality it's yield curve control or a real shake-up. How much volatility is that going to create in the bond market?
I mean, there's a lot of potential for volatility like that. I mean, I think we have to be cognizant that, there's a lot of talk about the balance sheet from Kevin Walsh and where he wants to go with it. I'm assuming that he's going to be a pragmatist as well. Doesn't want to create the bond market volatility. Certainly doesn't want to create any kind of potential for a bond sell-off, or more specifically, for international markets to lose interest in US Treasuries. So I think that this is going to be a gentle move to making some decisions on the balance sheet, which ideally do not create that volatility. But again, this is another thing that investors are going to be watching out for as we get Kevin Walsh into that seat.
You do wonder how fast he can do it without upsetting the bond market running off that portfolio.
Yeah, absolutely. I mean, that has been one of the risks, and you saw that once he was nominated, you did see that sell-off at the long end because there were concerns about balance sheet reduction. Now, with that in mind, any changes that are going to be done to the balance sheet have to be done in a really, really measured way, have to be very clearly signalled to the market. But also there are ways that it can be done where there is maybe a connection between the Fed and the Treasury, where the Treasury has maybe kind of a veto on additional QE at some point in time. So I think there's ways of doing it, but nothing is clear, and there's certainly nothing concrete out there that can point to for investors how this is going to play out.
What about this scoop of Bloomberg's that China's directing banks to trim their treasury holdings? When we see headlines like that, does it just kind of add to the international nervousness about US assets, or do we just kind of brush it off when China's already been getting rid of treasury holdings?
Yeah, I don't think this is a moment for major concern. I think it just is reinforcing a narrative which we've seen is already underway since kind of early last year, where there are concerns about the geopolitics of the US, concerns, of course, about the fiscal path as well for the US. And I think that's one of the reasons that we're seeing maybe some central banks around the world, some various governments saying, look, maybe we don't want to have full exposure to treasuries, maybe we want to diversify. I think the main impact of all this is, again, it just reinforces that global diversification story for investors, which has really continued to gain momentum into 2026.
Just finally, we have to talk about UK politics. You know I'm dying to ask you about it. Obviously, the moves yesterday pared back when Starmer got the full backing of every member of his cabinet. But are we going to continue to see volatility all the way to not just the May elections, local elections, but if Keir Starmer until he goes?
I think that's really likely. I mean, I think for the UK, it's a shame because actually there's some pretty good opportunities, at least from a macro conditions basis, the outlook for Bank of England easing, really raising the potential for domestic UK equities. And yet you've got that political risk now starting to play in, and you're seeing investors become a little bit more cautious and looking again, where else, in Europe can we go to? So unfortunately, I think it's going to be a tough spot for the UK as long as this whole political narrative continues.
Okay, Seema, great to see you. That's Seema Shah of Principal Asset Management. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. Time now for your front page news. First up, we look at the Wall Street Journal. The Trump administration planning to repeal the Obama-era landmark climate finding that serves as the basis for greenhouse gas regulation. The finding concluded that 6 greenhouse gases pose a threat to public health and welfare, and this is the most far-reaching rollback of US climate policy to date. Next up, we turn to the Financial Times. The US administration intending to spare companies that include Amazon, Google and Microsoft from upcoming chips tariffs. According to FT sources, the Commerce Department's planning to provide US hyperscalers with tariff carve-outs, which would be tied to investment commitments made by TSMC. And the New York Times leads with President Trump threatening to block the opening of a new bridge to Canada, escalating diplomatic tensions between the two countries. The Gordie Howe International Bridge, expected to open early this year, but was built by Canada to ease cargo transport between Detroit, Windsor and Ontario. Checking in on your futures picture, and things are just getting going really stateside. We are flat to the upside. A load of data coming out, the dollar in a narrow range and the 10-year at 4.18. Coming up, more on Alphabet's global bond spree. That's next. This is Bloomberg. It's 5:30 a.m. in New York City, 10:30 a.m. here in London. Good morning, I'm Lizzie Burden, in for Vonnie Quinn with your Bloomberg Brief. Let's set you up for the day. Futures gain after tech drives stocks near a record high. Investors await retail sales data out later this morning. A global bond spree. Alphabet lines up sales of sterling and Swiss franc bonds, including a 100-year note. And earnings continue with Coca-Cola, Marriott and Ford all on deck. A very good morning. Welcome to Tuesday. If you are just joining us, checking in on these markets, and we have futures treading water, really. Modest gains after the S&P came within a whisker of all-time highs yesterday. We've got a slew of economic data coming out stateside across the week. We start with retail sales later, but in the meantime, it seems like traders are holding their breath. So if we flip over to the bond space, you can see the 2-year yield stuck at 3.47 and not a lot of movement across the rest of the curve either. Yields down a touch as we await all that data. Let's get to our stocks to watch. Here's Abir Abu Omar.
Thank you, Lizzie. Let's turn to TSMC. This is one of the winners of the AI story. January sales have been up 37%. That is the fastest pace in months. Now, what we know about TSMC or the stock is that it's sustained AI spending despite some concerns about a bubble generally in the market. It is obviously the chipmaker of NVIDIA and Apple, and the stock is doing pretty well this year, up 17% since January. Flipping the board to a stock that is not doing so well when it comes to the AI story, and that is On Semiconductor. The revenues came shortly lower than expected. We have BI research from this morning that really highlights that the recovery in the company is slow and uneven. So the stock is doing pretty badly in the pre-market, 4.7% down. It spared some of those losses. It was down as much as 7% earlier. And then finally, AstraZeneca, we turn to the health sector in the final stock in the pre-market, up 1.7 in the European Open. It is actually the biggest gainer by points this morning, and that's after good earnings. We spoke to the CEO earlier, Lizzie, and he said some pretty good things about some cancer-related drugs and also on the weight management front. So those are the 3 stocks that we're watching before the open in the U.S. Lizzie?
Abir, thank you. I want to pick up on that tech theme. We have Alphabet kicking off its global debt binge to finance its record spending plan for artificial intelligence. The Google parent company is debuting sterling and franc-denominated bonds for the first time, including a 100-year note. So joining us to discuss is Matt Bloxham of Bloomberg Intelligence. Matt, we talk a lot about capex worries in tech. How significant is this issuance? One, how significant is it? One, because it's in sterling and francs, and two, because it's a 100-year note.
Yeah, I mean, this is an interesting tranche of a much bigger debt package. Obviously, they raised $20 billion in US-denominated debt yesterday, and I think there was like $100 billion of demand for that. So, strong appetite for Alphabet credit, which I think makes sense on recent fundamentals. They're kind of riding the AI wave quite successfully. But yeah, I think they're kind of looking to kind of broaden that kind of both the maturities and the currencies, to kind of take advantage of the wide demand appetite there is. But yeah, 100-year issuance is pretty exceptional. I mean, it does fit with, kind of the super long-dated maturities that pension funds are looking for now as their kind of liability match. But yeah, quite exceptional. But we did see similar in their issuance. I think they issued a 50-year maturity US bond, which is also quite unusual in that market. So definitely, testing the full spread of the credit markets.
It's like,
with success.
Yeah, it's like the church. It thinks in centuries. We also have to talk about TSMC. Abir was flagging the sales numbers earlier.
Yeah.
Pretty strong. Surely a good sign for AI spending.
Yeah, I think it is, and aligns fully with what we saw in terms of the capital spending numbers from the hyperscalers last year and their ambitious plans for 2026 too. So I think it would be a bit curious if TSMC's revenue growth wasn't remaining robust, given it is the major supplier to, in particular, Nvidia, also the likes of Apple. Obviously, there are some question marks about the smartphone market, but I think Apple's seen as being relatively immune from that because of its premium positioning.
And we've seen US insurance broker stocks absolutely pummeled because of an AI app. But I feel like we've had this conversation when it comes to law and financial analysts over the past few weeks. Are there other sectors that you're looking at where this is just the next thing?
I think the one that we're particularly looking at is travel. We've been doing some survey work recently on how consumers are using AI assistants. We started looking at it from a property perspective, but actually when we asked about other use cases, by far and away, the single kind of service that people want to use most with AI assistants is travel. So that, I think, is going to be an interesting part of the market to watch.
That's interesting because, I mean, you already have all the websites.
Yeah.
So it's
exactly,
not just an extension of that.
It's a transition. It's like, where do you start your search for your next holiday? Do you go to lastminute.com or do you go to ChatGPT and ask the question?
I know what I do.
Yeah. And I think what we're likely to see is more and more people going to ChatGPT for the answer to that. It's quite a complex thing. I want this kind of holiday with this kind of price point, with this kind of hotel, this kind of weather. It can go away and kind of bring back some interesting answers for you. And so obviously there's an obligation on the existing platforms to get integrated into those AI assistants, so they are still their content that gets served to you. But it's also an opportunity for kind of upstarts to kind of displace those established market leaders if they can cut a good deal with OpenAI or Google to be essentially the kind of default holiday information and sales platform. So it's going to be an interesting time for travel, but also lots of other services to see whether established legacy leadership in the online world translates to leadership in the AI agent world.
OK, so it's about specialisation. I have to say, ChatGPT designed me a fabulous Korean skincare tour. I'll have to see if it's good in real life. Matt, thank you. That's Matt Bloxham of Bloomberg Intelligence. We're just under 3 hours away from that US retail sales data. Bloomberg's Maddie Parker joins us now with a preview. Maddie, what are we expecting in these numbers?
Yeah, it'll be interesting to see. Obviously, we have Coca-Cola reporting. They are expected to have a pretty strong quarter on sales and revenue growth. Their shares obviously up already about 12% this year. They've been able to really capitalise on that kind of increased demand for non-alcoholic drinks and things like that. It'll be interesting to see. We obviously also have CVS coming through. It'll be interesting to see how they've been able to respond from the new announcements from the US government around Medicare Advantage, and investors will really be hoping to get some commentary on how they're going to respond to those changes going forward.
And we also have Coca-Cola reporting later. Looks like it's going to have a solid quarter.
Yeah, I think so. It's going to be an interesting one. They've been able to really have that kind of growth on the back of that demand. They have a bit of a history really of exceeding Wall Street expectations. So it'll be interesting, obviously, for investors to see it, and also to see if there's any further commentary on their CEO changeover. That's obviously coming imminently in March. So there's a bit of a buzz around the company at the moment, really.
And CVS results as well. How much of a hit are they going to take from the government trying to keep Medicare Advantage payments flat?
Mm-hmm. Yeah, I mean, it's obviously a huge change in that industry. CVS are one of those where obviously it's a diversified business. There are some bright spots. People are expecting some growth, obviously, from their pharmacy business. And maybe that diversification will help cushion them a little bit from that impact. But what investors are really hoping to, and I think CVS will kind of be on the hook a little bit for details about how they're going to respond to these changes. Obviously, that is such a key area of growth in that industry. So it'll be interesting to see kind of how they respond to that.
And while we're waiting for those earnings, Maddie, we have the news that Target's cutting about 500 jobs. Is that significant in the scheme of things for Target?
Yeah, it's really interesting. I mean, this is obviously coming after their huge 1,800 corporate roles that they cut at the end of last year. It's kind of their first reorganisation in the company for over a decade, and this is all happening under their new CEO. So obviously, while these job reductions are smaller in scale, they're kind of underscoring that effort. They're saying, oh, this is a shift in our investment. We're kind of shifting away from that corporate side of things. We're really trying to invest into our over 2,000 stores that they have in the US. So this is more of a continuation of his strategy in terms of that kind of shifting investment from A to B. But it'll be interesting to kind of see how they actually go forward in terms of their store investment from this point on after making all those cuts on the corporate side of the company.
Maddie, appreciate the context. You've got a busy day ahead of you. That's our Bloomberg consumer reporter, Maddie Parker. Now, on to some other top stories trending on the terminal this morning. The VC firm backed by Fidelity's Johnson family has shelved plans to sell its holdings in dozens of Chinese tech companies. According to sources, this comes as geopolitical factors become less of a hurdle and valuations improve. The firm had planned to unload investments in about 40 tech companies for roughly $400 million. Elsewhere, Standard Chartered CFO Diego Di Giorgi has resigned to join Apollo. His unexpected exit was greeted negatively by investors and analysts. Di Giorgi was seen as one of the frontrunners to eventually replace the longtime CEO Bill Winters. He'll be Apollo's head of Europe, the Middle East and Africa. And House Republicans advanced a procedural motion to block a vote on President Donald Trump's tariff agenda. The House will vote on the motion this week. House Speaker Mike Johnson expects the rule to be approved. Well, coming up, we head to Berlin for a conversation with Munich Security Conference chair and former German ambassador to the US, Wolfgang Ischinger. That conversation next. This is Bloomberg. This is Bloomberg Brief. I'm Lizzie Burden in London. Now, the Munich Security Conference is kicking off on Friday. Bloomberg's Francine Lacroix is with us now for an exclusive interview with the Munich Security Conference chair, Wolfgang Ischinger. Fran.
Lizzie, thank you so much. Ambassador Ischinger, thank you for joining us. I know we're all looking forward to being in Munich to try and figure out what the next crisis is. I mean, the world seems very unpredictable. The world seems very volatile. What do you think is the single biggest security risk that we're currently underestimating?
Well, I think we actually have two major missions coming up this weekend in Munich. One is to try to do our best to repair trust damaged, confidence lost during the last months or so and weeks in the transatlantic relationship. The backbone of the Munich Security Conference has always been the transatlantic relationship. Then beyond that, we need to take a hard look at the damage done to the international order. I mean, Russia now, in just 2 weeks, will enter into the 5th year of its aggressive war, illegal war waged in and against Ukraine. China has been ignoring international legal rules in the South China Sea. Other countries are committing genocidal activities all over the place. We look at a disintegrating international order, and that's actually one of our most important concerns, which is why I think we need not only to talk about the transatlantic relationship, but the many other conflicts and bloody wars that have been going on and have not yet been taken care of.
But Ambassador, if we're living already in this post-rules-based international order, what do you think will replace it? What is replacing it?
Well, I certainly hope that we can preserve at least the basis, the fundamental elements of what we used to call the West, namely a values-based Euro-Atlantic community where the United States will continue to consider itself, at least to a certain extent, a European power, and where Europe can actually develop itself into an internationally respected actor that will not be ignored, neither in the Middle East nor when Russia starts talking about the future of Ukraine. I find it totally unacceptable that we, 450 million Europeans, sit on the sidelines while these discussions about the future of Ukraine are being conducted. This is our continent. This is our future. This is an existential threat to the security of Europe as a whole. So lots of questions.
But whose fault is that? Is Europe actively engaging enough? Like, if there was ever any question that U.S. security guarantees weren't strong enough, did Europe waste the last decade? Should it have done more?
Of course we should have done more, absolutely. I think we're now doing more. Many of us here in Europe have heard the shot. It would have been impossible for me to imagine as recently as 2 or 3 years ago that my own country, Germany, would go from 1.2 or 1.3% of GDP to the objective of reaching 5% in just a few years' time. We're going to be spending twice as much on defense as our closest partner, France, over the next few years. In other words, we heard the shot, we're working on it, we're trying to make sure that in the United States, voters will no longer have a reason to consider Europeans as free riders. I think that's probably the single most important healing thing for us together in terms of our relationship with our friends on the other side of the Atlantic. We want the United States to stay in Europe as a partner, as a reliable partner, but we understand that we need to do a lot more ourselves to carry the ball of European security and defense.
Ambassador, what does success in Ukraine look like today, realistically?
Well, first of all, of course, the most important thing for the terrified and terror-stricken population of Ukraine is an early ceasefire, and I'm really totally not only disappointed but deeply moved by the fact that these discussions, which have been now ongoing for many weeks, months, have not produced a meaningful ceasefire. That's the single most important thing. The second most important thing is that out of a ceasefire will come a regulation, a peace agreement that will not carry with it the risk of repeated Russian aggressive acts against her European Western neighbors. In other words, can we think in terms of reducing the numbers of Russian military divisions present in the western districts of the Russian Federation? Can we think of security guarantees for Ukraine and in Ukraine that are worth more than the paper on which they are written? At this moment, if I were an Ukrainian decision maker, I would not have full trust in the kinds of promises and arrangements that have been sketched out so far. I think a lot more needs to be done to make sure that European security is going to be stable and will continue to be stable and capable of deterring repeated Russian attempts to enlarge the Russian sphere of influence and domination in Central and Eastern Europe.
Ambassador, I was going to ask you about that. Is there a danger that actually the U.S. pushing for negotiations means that deterrence is weakened elsewhere?
Well, I think it's fine for the United States to push for negotiations, to push for a success in negotiations. But let's be clear about this. The ones who are not accepting American and European and Ukrainian proposals are not the Ukrainians, the ones who have been playing for time and not making a single concession at any moment in these past months and weeks has been the Russian Federation. I agree with intelligence assessments that seem to indicate that Russia has no intention of giving up their own maximalist goals with regard to Ukraine. And that means that a lot more pressure needs to be applied on Russia. Russia needs to understand that the United States and her European allies will not allow Russia to conquer Ukraine, not now and not in the future. And we're unfortunately relatively far from having reached that point where Russia will understand that.
Ambassador, I mean, one thing that we're also trying to talk about is whether you think AI, and I know this will be discussed at Munich, AI lowers the threshold for global conflict.
Oh, absolutely. We're actually going to create this weekend in Munich a special tech and AI advisory council with eminent specialists from around the world, including American personalities, to make sure that going forward, the Munich Security Conference will, in terms of AI, its military implications, its energy policy implications, that with regard to these issues, we will be in front of the curve and not behind the curve, because I think there is no single more important issue over the horizon than the future of AI and how it will affect our lives, but even more importantly, how it will affect security and defense issues going forward.
Wolfgang Ischinger, thank you so much for your time. That was, of course, the chair of the Munich Security Conference. Ambassador, we really look forward to seeing what happens in Munich. With that, Lizzie, I'm going to hand it back to you.
Francine, thank you. And of course, Francine will have full coverage from the Munich Security Conference as well. That was Francine Lacroix. Well, coming up, retail sales kicking off a deluge of key economic data this week. Your day ahead is next. This is Bloomberg. Now a look at what's ahead today. First up, earnings including Coca-Cola, CVS and Marriott out before the bell. Then we have US retail sales numbers at 8:30 a.m. Eastern. And then Ford reporting earnings after the market close. Let's take a look at your micro movers. TSMC had revenue jumping 37% in January. AI spending marching on. And as you can see, the shares are up in the pre-market. They are lower, though, for On Semiconductor. They, of course, also with numbers. And then we have Credo, preliminary revenue underscoring the AI demand, and the shares rocketing in the pre-market, up 16%. Let's check on your macro movers as well. S&P futures treading water, really flat to the upside. We're waiting for this data to come out. Retail sales later on, the dollar range bound and the 10-year there at 4.18. That does it for Bloomberg Brief. Surveillance is coming up next. This is Bloomberg.